Good afternoon, ladies and gentlemen, and welcome to today's presentation on how to be successful with spread trades. Today we're going to take a look at criteria for the stocks and options to improve spread trading performance. For those of you who don't know me again, my name is Mike Chupka. I'm the Director of Education here at Power Options. Today we're not only going to walk you through what some expectations should be for your spread trading positions, what is a reasonable and realistic expectation for the different spreads, but what underlying criteria to use, and of course what we've found ourselves historically that have enhanced and really shown good performance for the various spread trades with all the combinations that are available in the different credit and debit spreads as well. Well, this is part 2 of our 4-part series that we're hosting this week. Yesterday we introduced the structure of debit and credit spreads, the pros and cons in each, and some comparisons of the different trades. The actions, of course, and the goals of the position. But today we want to discuss a little bit furthermore into the expectations, the reasonable expectations of what you should look for and what you should find with a credit and debit spread. More of the structure of the trade itself, what we found has worked historically, and what should show up based on how to set your spread, based on difference in strike prices, maybe range out of the money, probability, and more. Then we're going to discuss the criteria, and we're also going to discuss, some testing results that we have moving forward and what Power Options subscribers will be able to see in the near future as well. All right. Now, as we know, of course, from yesterday and just in general, our expectations for spread trading. Well, we know that spread trades offer the benefit of leverage. I can trade a stock. I can take advantage of what I feel is a bullish or bearish stock with a spread trade with only investing maybe 1/5 to 1/10 or even less of the margin requirement of having to buy the stock or short the stock as well. Many leverage spreads will offer double-digit returns, even for short-term weekly trades. But the trade-off is we also have the risk of 100% loss on our margin requirement if there is a sudden event that, of course, just goes against our expectations and we see a large move in the stock one direction or the other for something that we could not have seen on a stock chart, technical indicators, or any other events. Now, when we look at a spread trade, we all know what we want, don't we? We all would want to see a spread trade that offers a 95 or 98% probability of success with a 5 to 10% return. But is it better to look for the higher probability or look for the higher return with a slightly lower probability? Well, that's what we're going to try to look at today as well, in addition to other structures. Before even jumping to the criteria, one of the main questions that everyone has, especially with the increase and introduction, all the weekly options that are available, with 50-cent spread differences on some stocks, dollar point spread differences, $1.50, $2, $2.50, the sky is the limit. A common question that we get, and this all is available, is that aren't 1-point spreads better since they have less margin and lower risk? What about the advent of 50-cent spreads on weekly options? And of course, you say, well, I looked at a spread that only had maybe a 50-cent spread difference for weeklies, but if I look at a 5 or 10-point spread, I see a much higher net credit. Which is better? Well, let's take a step further into that first, and let's talk about how everything goes hand in hand. As I mentioned, we'd all love to see a debit spread or a credit spread that offers a very short-term expiration, 5 days out or less, maybe 4 days out, with a 95% probability of success, a 20% return, and perhaps the lowest margin requirement. And the difference in the strike prices that you have to put up for a credit spread, or of course the debit payment would go lower if you're looking at a 50-cent or a 1-point spread difference. Now, if those trades do exist, our patented search tools will find them. But we have to have reasonable expectations for entering a spread. But what are reasonable expectations? Now, we offer a lot of tools on Power Options, and one of them It's hidden in the Learning Center as the optionable stock statistics page. This goes through every night and takes a look at the average values, minimums and maximums for things on all optionable stocks. Average stock price, average volatilities, average option bid price, of course, average theta, and more, as well as the minimum and maximum. So as of this morning, some of the notable stock averages for optionable stocks. Well, the stock price, the average stock price of every optionable stock is $42.11. The average 50-day stock volatility is 0.33, or some of you might call it 33%. Our average market cap is around 9.6 billion, and the average earnings per share growth, this is more related to a bullish position, looking for a positive growth, positive management, but on all optionable stocks that offer earnings, of course, indexes and ETFs will not. But the average growth in earnings is about a positive 3%. Now, why is all that relevant? It gives me a starting point to discuss stock criteria and allows us to view expectations. Now, I ran a search. I just took one of our standard option strategies and power options, and I looked across the universe of optionable stocks to find stocks that had an average price above $40 per share, where the 50-day stock volatility was between 30%, a little bit below the average, but no more than 66% or 0.66. Why? I don't want to go 2 times the average and look for more volatility. Looking for a market cap, let's say above 5 billion. I'm sorry, that should be 5 billion. My apologies there. So yeah, we're going to look at that at 5 billion. And that's a big B. All right, and an earnings per share growth above 3%. Now, I'm just going to add this in for a bullish estimation. So we're going to look for stocks above the 50-day moving average as well, and also stocks that offer weekly options, and stocks that have no earnings between now and expiration. So with that simple search, we came up with about 11 different securities. CMG, which we actually looked at yesterday, that matched a bearish set of criteria, and we looked at a bear call spread on CMG. NetEase, Baidu, Netflix, NVIDIA, stocks ranging from $300 down to Applied Materials at $43.94. Okay? Now, I could compare all of these, but I've already kind of done that for you. But I am just going to use an example of the lowest priced one. Okay? So look, for the sake of time, right now we're going to take the low listing. We're going to take AMAT at $43.94. And I'm going to go over to power options. And what I'm going to do is we're going to use the midpoint spread chain for bullish positions. And we're going to look at the expectations for bull put bear call credits. We're going to look at the credit spreads based on 1 week out, 2 weeks out, and 1 month out for different strike prices to help give us an average expectation of what we should see percentage return wise and possibly even net credit wise. Although the credits would be higher with the higher price stocks. But let's go ahead now and take a look. And I'll show you what I mean by expectations for the various positions. All right, so I'm going to navigate over to the Power Options suite of tools real quick. And what I'm looking at here is our midpoint spread chain for Power Options. Now, some of these numbers you might not be able to see very well. But don't worry, I'm going to review that for you in just a moment. What this tool allows me to do is quickly see what credit spreads, debit spreads, or parity trades are available on any expiration cycle for some basic criteria. Now, what am I going to look at for my spread criteria? First, let's take a look at the credit spreads here for AMAT. Oops. We're going to look at the 50-point strike differences that are available. This is one of the reasons why I chose the lower price stocks. We know we want to be slightly out of the money. I'm going to use a minimum probability of 70%. That's probably where most of you are starting, looking for a theoretical probability above on your position. So you want to be somewhat out of the money, have that better probability of success. But let's just take a look at our expectations. I'm going to start with the bull put credit spreads over on the right-hand side. And we're going 9 days out. I'm ignoring the 2 days out since this is a Wednesday presentation. We know the 2 days out are going to be so small. 9 days out, September 1st, next full weekly series. With AMAT at 43.97, a 42.5 to 42 strike bull put spread, meaning I'd sell the 42.5 up here, and we'd buy the 42. So we have a 50-point strike difference. We can get a 19% return with a 78% probability for a 9-day trade. But our total net credit is only 8 cents at midpoint. We could go to a higher probability at 85. It only offers about an 8.7% return, but the net credit is only 4 cents. And on the bear call side, we see similar numbers here. The 16.3% return with a 78.9% probability, but a 7-cent net credit off of a 50-cent margin requirement. Remember, I'd have to cover the margin here, so we'd be looking to make 7 cents on a risk of 43 cents. The true risk on the spread position. Okay, well, let's enhance this. We're looking at the 9th, 1 week out. Let's go to the 1-point spreads, still focusing on a 70% probability or higher. What will we expect to see? Well, I don't know if I'm going to see as high as a percentage return due to the higher margin requirement. But again, here at the 78.9% probability we looked at before in our bull put, we're taking in 11 cents of net credit. Much better than what we saw before, percentage-wise, 8 cents versus 11, and it's a 12.4% return. On the credit, the bear call side, it's about the same. We see a double-digit percent return for only 9 days out with a good probability above 75%, but we're only talking 12, 11 cents of net credit. Okay. Let's go one step further. I'm going to go ahead and go to the 2-point spreads very quickly for the same expiration. And now we're getting into 25-cent and 15-cent net credits. But of course the ROI is much lower because I don't go up exponentially. Meaning that by going from a 1-point spread to a 2-point spread with the same probability of about 78.6, 79%, my return based on the margin requirement drops from 12% to 8.7. My total net credit, though, did go up from 11 cents to 16 cents. We could go to the 5-point spread and we'd see the same thing. My net credits might go up to 20 cents at the 79% probability, but my return on investment would be much lower. It might only be in the 5% range. Now, what do we talk about with a 1-point spread? But rather than going 10 days out, 7 days out, let's go to standard September expiration. Let me take off the 9-day. There we go. And what do we see in this case? Well, going to a 80% probability with a 1-point spread, I get a 21-cent net credit or an 11.1% return. So the return on investment is about the same, but we're getting that better net credit. Okay? And of course, we could increase that and go higher to the 2% range, or the 2-strike different range, excuse me, but we know what we'd see. Higher net credit, but unfortunately the return on investment will drop as well. Now, what does this have to do with really anything? Well, it has to deal with us looking at our expectations, reasonable expectations. So what did we see? Well, the 1-week out spreads offered between, a 4 cent and 7-cent net credit with a reasonable return and still the probability we'd want. Now we go to the dollar-point spreads, increase the spread width, increase the margin, and we go to about 17 cents, 10 cents, and 5 cents in a reasonable range of 70% probability or higher. We still see double-digit returns, but down to single digits. And so the 2-point spreads, of course, gave us better net credit, but the returns are statically lower. We would see the same thing if we went 2 weeks out in time. We still get reasonable returns for 50-point spreads, but we're talking about 6-cent net credits. Still a double-digit return. We get almost double or 30% higher credits with using a wider spread, the 1-point spread, but the return's lower, and so on. And of course, at 23 days out, we can get higher net credits on all 3 cycles, 50 cents, 1-point spreads, and 2-point spreads. And even the 5-point spreads give us a much wider net credit, but you'll only see single-digit returns with the same probability or the same delta on your short option. Okay? Well, what does this tell us? Well, it tells us that if you're interested on return of investment, which we all are, the lower strike spread widths offer a better percent return based on the margin. However, I do get a lot of phone calls, a lot of questions during the webinars. Investors who are solely looking to they only have, I should say, $2,000 to invest in spreads. And when they look at the 50-point spreads, they've set themselves a goal where they only want to trade maybe 4 or 5 contracts on 5 positions or so. For them, getting an 8-cent or 6-cent net credit doesn't work out. 6-cent net credit with 5 contracts, you're talking about $30. And if your commissions to enter a spread are $12.95, you ate up close to 40% of it with just the commission cost as well. The percent return would look high, but your commissions are really going to destroy that. So in that case, do you trade more contracts to get a better number? Well, now remember, your risk is also increasing as well. Return of investment might be the same. The commissions aren't taking as much out of the premium if I go to 10, 20, maybe even 40 contracts of a 50-point spread. But at the same time, now I'm putting more capital at risk instead of diversifying more. Okay? So, I have an answer. Lack of a better term, proof is in the pudding. But I'm showing you this because I want you to see what are your reasonable expectations when trading spreads. Before we even get into the criteria and the structure, what didn't we see on that field? Did we see 30% returns on any spread with a 70% or higher probability? No, not 9 days out. Maybe 30 days out we did. With the standard expiration on the 50-cent spread, I think there was one that we saw that had a 70.6% probability and a 30.1% return. Okay? Did we see any spreads with the 90% probability? We did see some that were on that list because we just screened above 70% or more, but offering a return above 6%. Only on occasion. And that was with a 3-cent net credit at midpoint, maybe the best possible price you could get on the 50 cents with this 9-day out trade, a 50-cent strike difference. Did we see credits over $1? Well, no, of course not. You can't expect a net credit of $1 if you're looking at a 50-cent spread. You can't look at a net credit of $1 if you're looking at a dollar spread. If you're looking at a 2-point spread, you might find a $1 net credit. But you would be roughly out of the money. With AMAT at 43, you might be selling a 45 put and buying the 42.50 on a 2.5-point spread. You might get close to $1 in that or a 1-to-1 risk-reward ratio, but now you're at only a 50% probability. Okay? That's the trade-off. Everything goes hand in hand. So 15 slides in, what do we know? Well, the 50-point spreads and 1-point spreads will offer a good leverage return with both weeklies and monthlies, but you have to accept a low net credit. You have to accept you're going to see 5-cent, 6-cent, and 10-cent net credits. Okay? 2-point and 5-point spreads are going to offer you a higher net credit if your minimum requirement is to make 15 or 20 cents on a 9-day, 14-day, or 23-day trade. You're going to have to go to the 2 and the 5-point spreads. But remember, the return on investment drops. we might see single-digit returns, 8% returns, which for a 14-day trade is not bad. But to get a 20-cent net credit on that, we'd have to use a 2-point spread roughly 14 days out. Okay? So if your goal, what you've set aside as your trading plan for credit spreads, for debit spreads, for example, is to get a low risk reward or to see a $1 credit with a high probability, you're going to have to go to $5 to $10 ranges. All right? Now, during a poll in yesterday's webinar, 96% of our attendees said they traded spreads under 30 days. A structure we can use for debit spreads is what are called out-of-the-money debit spreads. When we talked about setting up a credit spread that's out of the money, where the bull put, both strikes would be below the stock price, and for a bear call, both strikes would be above, so we get that probability of 70% or more. Okay? Some investors will use what's called out-of-the-money debit spreads instead of in the money for the higher probability. They'll go further out in time, 2 to 3 months. And on a stock like AMAT, with a bull call debit spread, they might sell the 45 call, as I mentioned, and buy the 42.5 to pay a debit of maybe only $2 or less, maybe $1. So if the stock moves above 45 in the next 2 months, they get $250 back and might see a 50, 80, or 100% return. Okay? They're not going to have the probability range we're talking about. Okay? Most of the investors yesterday, during a poll as well, were looking for positions with a high probability and shorter term. Okay? Which is OTM for the credit spreads. We want to be out of the money. And ITM for the debit spreads. Now, a higher probability, of course, means less worry. Don't have to watch the position as much, but we have to pay attention to it. On power options, I focus myself on probability with my credit spreads. With our testing and our discussions, as you can tell, and our search tool allows you to use the probability as well as delta or range out of the money. And it's focused on the short option. That's your pivot in every spread. That's your focus. What is the probability above or below of the option you're selling in a spread, or the range out of the money of the option you're selling in a spread, or the delta, of course, is the option that you're selling, whether it's a bull put credit, bull call debit, bear put debit, or bear call credit. But what does that translate to? Again, I'm going to show you that again. Let's take a look at AMAT. We're going to look at just the put chain for the 9-day out series, and again, the 23-day out series. Okay, so here we see a screenshot from earlier this morning. Our probability ranges that we saw, here's that 78.5% probability at the 42.5 strike from 9 days out. Okay, so we've got our 78.5% probability, 42.5. For 9 days out, that translates to 3.4% out of the money with a delta of 0.21. Negative 0.21. Okay? So an expectation on our average stocks, optionable stocks. Short options, the option that you're selling, your pivot option in any spread, looking for a 70% probability of it being above or below. If this is a bull put, we want that probability above. So a 70% probability, the lowest one here at 69.9%, translates to about 2% out of the money for 9-day trades, and a delta of about minus 2.9, close to minus 0.3. The delta and the probability are close. Subtle differences, but they are close. If you wanted 80% probability of success on your spreads for weekly trades, that's about 3% out of the money, 21 delta. And if you look for 90% probability, here we are here at the 4150, you're 5.5% out of the money with a 0.9% delta. But look here, what would that expect? That's 11% premium at the 41.5. If I did a 50-cent spread, we're looking at about 3 cents of net credit. And a 1-point spread, you're looking at 5 cents of net credit. Okay? So, but that's what your expectation is. Everything kind of goes hand in hand. 23 days out, now we're allowed to go a little bit further out of the money, a little bit more cushion from the stock price to get into our probabilities. So now a 70% probability, instead of being 2% out of the money, is 3.4% below the stock price. 80% probability is about 5.6% with a delta of 0.19. Again, delta to probability is close. And now with a 90% probability, almost 30 days out to next standard expiration, we're looking at an 8% range out of the money with an 11 delta. I'm just showing a puts because the calls would be the same. And if you're comparing a bull call debit, well, going in the money, 90% probability would still be at the 8% in the money for the bull call debit spread, the call that you're selling, and buying a deeper in the money one, and you'd have about an 11 delta. It just translates just slightly reversed. Okay, so why did I want to show this to you? It may be what you already know, but it is important to review. We know the lower strikes offer a higher return on investment, but less credit. Shorter term weeklies can have a low delta and a good return, but you're probably only focusing to 2 or 3% out of the money on a credit spread, or 2 to 3% in the money with a short option on a debit spread. What does that mean? Well, it simply implies that the stock can only fall 2 or 3% in a 4 or 5 day period, assuming all things stay normal and there's no surprises, no announcements, nothing happens geopolitically or globally. You only have a 2 to 3% cushion with the shorter term 5 day out, maybe 9 day out trades. Now, of course, the longer term monthlies, you can go further out of the money for better protection, better cushion, still getting a good premium, and those high single-digit returns of 9, maybe 10 or 11% into the double-digit range with a 90% probability. But now it's longer time. Okay, now what's the problem? Now the problem is you have more time for the stock to move against you. Okay, so that's the trade-off. Weeklies versus monthlies, 50 cents versus dollar strike differences. This is what your expectations should be. Now don't worry, we're talking about this, applying it to the structure and the expectations. Again, should you expect to find a 4 or 5 day out trade with a 50-cent strike difference, a 90% probability, and a 25-cent net credit? Absolutely not. The power options tools will allow you to find that, if it exists. But that's not a reasonable expectation. You're talking more along the lines of 3, 4, 5 cent net credit on a 50-cent spread with an 85% probability. Maybe only 7 to 8 cents on a dollar point. 7 to 8 cents of credit on a dollar point spread that has an 80 to 85% probability or more. I want to show you these expectations so you can help determine your own structure and trading plan. Why did I compare what I just showed, including the delta ranges and the range out of the money? Because if you prefer to use delta in your searches, even if you're not using power options, or range out of the money as opposed to probability, I wanted to give you an idea of what you would expect, whether to be just 7 to 10 days out or 20 to 30 days out, what your expectations should be as far as how would probability translate to delta. It is relatively close in most cases, unless there's an event coming up, but also the range out of the money. Is a 2% cushion comfortable enough for you on a 50-cent spread where you're getting 3 cents of net credit and an 8% return? I don't know. You might want to structure the trade differently based on your personal allocation. Okay? So again, will spread have a delta of less than 20 and offer a 15% leverage return for weeklies? No, not likely. Okay? Going into the 80-85% probabilities, you might see 12, 11, 8% yield for a 5-day trade, which is fantastic. Annualized return. You shouldn't have the expectation of seeing a 20% yield with that low of a delta and that high of a probability. Can you go 5% out of the money on weeklies and expect a 15 to 20% return? Well, maybe the 50-point spread, but a credit of only 6 cents or so. And that position probably has a much higher volatility, which is something that we probably want to avoid. Okay? So, taking into account what is your comfortable level for safety, range out of the money on a position, percentage-wise away from the current stock price. What are your necessities for income? If you're only trading 5 contracts of a position, even if you're trading 10 different spreads per week, and you're only doing 5 contracts per each, is a 3-cent or 6-cent net credit going to satisfy your needs, even though your margin's only 50 cents? Not likely. The percentage return might look good, but now you have to factor in your allocation and how much the commissions are going to swallow. Okay? So, we promised we were going to view the expectations. Now, what does work? Now, you did come here today to see a roadmap for stock and option criteria for spread positions. Well, so far I've given you an outline of expectations and structure. Some ideas on criteria. Okay? For the bullish positions, I typically wouldn't want to go, and even for bearish positions, we talked about the average volatility being around 0.33 across all optionable stocks. Well, in general, I want some volatility for a good premium, but I probably don't want to go double the average to take on too much risk. Anything that has a historical stock volatility double the average is fluctuating too wide, even on a 5-day or 10-day basis. So I probably want to avoid something like that for a neutral to bullish, even a neutral to bearish structure. But I haven't given you any ideas on always do this and never do this. And the reason why is that everyone is different and everyone has their own risk-reward tolerance. During yesterday's discussion, I had mentioned that one of the main things I'm always going to do, if I'm looking for a bull put credit, bear call credit, or even a debit spread on a specific stock, first thing I have to check is to make sure that stock does not have earnings between now and my expiration date. I don't want to get stuck with a surprise where a position that looked profitable based on current trend, lower volatility, strong movement for bull stocks, for example, has a surprise, drops 20%, and a position that looked like would give me a 15% yield for a 5-day trade is now 100% loss, where I maybe gave back a full $1 or even $2 with only collecting 11 cents or 8 cents on the position. Okay? Well, someone commented and said, why wouldn't I just use ETFs as a whole to avoid that? Well, that's something that you can do if that's part of your trading plan. To avoid earnings, to avoid unexpected buyouts, boardroom scandals, you could just look at indexes and ETFs and avoid the leveraged ETFs, 2 times bull, 2 times bear ETFs, and more. Okay? That is something that could be done. But you have to develop that kind of structure and idea yourself. Okay? Oh, I do apologize. AC had commented in. He says, real quick, I apologize, folks. AC says, good morning. I was having problems logging into the system and viewing the webinar, even though my computer is fine. Will I be able to access the recording? Yes. All of our webinars are recorded. You would have received an email yesterday letting you know that the presentation from yesterday was available on YouTube, on the Power Options channel on YouTube, and on our public archives page. Today's presentation will also be posted there as well. Okay? All right. So let's move forward now, again, and let's discuss the criteria. Okay? What criteria, stock or options related, will I look for when doing a bull put, bull call debit, or even a bear call credit or bear put debit? I'm going to be honest, sometimes it's best to stand on the shoulders of giants, especially when I have to put together dozens of webinars over a 1-month or 2-month period. About 2 years ago, Ernie Renner, the president and founder of Power Options, did extensive testing on covered calls and naked puts, both monthly and weekly. Okay? He ran through exhausting combinations of technical and fundamental criteria to find a set with optimized best performance over an extended period of time, 1 year, 2 years, and 3 years. We incorporated this into some of the tools we do offer on Power Options. There's the weekly picks of the day for naked puts, and it reflects his testing and what he went through. Of course, also the monthly for naked puts, covered calls, and weekly for covered calls as well. Well, if the criteria he spent going over things such as Bollinger Band ranges, 52-week highs, 52-week lows, middle of the range of the 52-week high and low. Dividends, not paying a dividend, indexes versus ETFs versus standard stocks, earnings between now and expiration, not between now and expiration, looking at higher volatility compared to mid-range volatility compared to lower range volatility, and so forth. Covered calls and naked puts are neutral to bullish positions. We want a successful track record of stocks staying the same or moving up in price for those strategies to have a high success rate. Well, if it's good for the goose, it's good for the gander, isn't it? And if it's maximized for one bullish strategy after close to 100 different iterations of stock criteria, it's probably going to work for other bullish strategies as well. Neutral to bullish, not necessarily long calls. Okay? So what was it found out? For the bullish stock criteria, the best performance for underlying stocks was he was looking for stocks prices greater than 10, no earnings between now and expiration, a stock trading above the SMA 20, so above the 20-day moving average, an average volume greater than 500,000 shares per day, and that's over 90 days, and a MACD positive crossover by at least one day. Now what's interesting is that in addition to this, during the same time period, we used our strategy testing tool, which is a little different from the historical tools we offer on power options, and we tested criteria for the spread positions. And a very interesting discovery was that long-term, over a 1 or 2 year period or more, although weekly options are available, the spreads that were 14 days out or 2 weeks out in time, between 8 to 17 days out in time, outperformed the same track record using the same stock criteria, but forcing it to be every week. So in other words, when we were testing and I was looking at positions that I'd open a position on Monday for that particular expiration week, so 4.5, 5 days out in time, and we'd run that for a 2 year period looking for reasonable net credit, probabilities above 75% or more, with some of the same MACD and SMA criteria that we use for the neutral positions, neutral to bullish positions. If I push that 2 weeks out for the higher net credit, even though the ROI was less, percentage-wise, you look at the comparison, the net credit maybe moved up 8%, but the ROI dropped down 12% with a 2 week spread. The 2 weeks outperformed the weeklies every iteration. It was kind of amazing. And I'll talk about that in just a moment. And the 2-point spreads outperformed 1-point spreads, believe it or not. And that was kind of interesting. So now that I saw that 2 weeks out were outperforming the 1 week out, you're taking more losses with the 1 week out positions, and you were receiving lower net credits up front, which when you did suffer a loss, you might have been wiping out 20 trades instead of only 5 to 10 trades on the position. We did see that the 1-point spreads had a lower return and then sometimes a loss using the same exact stocks and the same exact criteria with a 2-point spread. It was fascinating to see that because it's not what we'd expect. I expect to see that higher ROI perform better over time with a 1-point spread or a 50-point spread. But the problem was because the credits were so small that when you did take a loss, it wiped out more of your gains that you'd achieved with a 1-point or a 50-point spread, even 1 week out or even 2 weeks out. It was very interesting. All right, now with that in mind, before I talk about the results, I'm going to talk about the criteria sets. I'm going to use power options, and I'm going to show you the criteria sets that we look at for bull put credits, bull call debits, and of course our bearish strategies as well. Okay? So let me go ahead and navigate back over to power options. And instead of doing our midpoint spread chain, which we were using for our expectations, I'm going to go right into bull put, and we're going to go right into the search. Now when I first access the search, I'm going to see a listing of trades that match a default criteria set. There we go. And we're going to talk about that in just a moment. But I want to scroll down here to the parameter field where we set our settings for the position. And this is what we used for bull put credit spreads. Okay? It says the screen did not change. Oh, I apologize. It should have done it automatically for me. It did not. My sincerest apologies. David, how does that look now? Fred? There you go. Should have changed automatically. Sorry. My apologies, ladies and gentlemen. All right. So let me scroll back up. When I went into Power Options, went into Bull Put Credit, went into Search, came up with 4 Bull Put Credit Spreads, 16 and 9 days out. Why not this week? Well, again, because what we looked at was the expiration date that outperformed the others, 8 to 17 days out in time, avoiding the current weekly position. Looking for a minimum net credit of 20 cents and a percent return 2%. Now most of them are going to be well above that. But remember what we talked about. I wanted a probability of 75% or more. 70% is okay, but even 14 days out, that just gave me sort of a 2 to 3% cushion. Going with the 70% probability, I might get a higher net credit in this case, but I also want to make sure that I've got at least a 3% cushion. So hand in hand, 75% probability, 3% out of the money. And of course, the strike difference is greater than 2 strikes, greater than or equal to 2 strikes apart. There's 2 reasons for that. Number 1, Ernie's testing he did 2 years ago already showed that. I needed to reprove it, and I did. But there's another reason that was asked yesterday, why do you focus on these 2-point spreads? Number 1, based on our past historical recording, we saw that it outperformed 1-point spreads. Why 8 to 17 days out in time? Because over 2 years of testing, this greatly outperformed going week by week, forcing ourselves into a lower net credit range, less value out of the money to get a decent credit. We still have a probability, but with swings in the market, when you had that lower net credit, one loss wiped out more of the gains, and that was the issue. We talked about the stock price. Okay, I'm sorry, we talked about the stocks themselves, and what Ernie did also, okay? Oh, yes, okay, I'm sorry, Roy asked a question. Was it Roy? I'm sorry, it's Ron. My apologies, Ron. He says, did Ernie test any spreads above 2? No, but I did. Okay, I'm going to reflect on some of those in just a moment. I'm going to show those results in just a moment. Okay, and I apologize that they're not going to be in slide form. I'm going to show it to you in a different form. There's a reason why, and I'll explain that in a moment. Okay, but these are the settings, rough structure that we're looking for. But at the same time, what else did I want? Well, let's go to technicals. Remember, we wanted stocks that are trading above their 20-day moving average. And at the same time, I want to look for a strong MACD crossover. In this case, we're looking for stocks where the MACD has crossed the signal line by at least 3 days. Remember, this is for the bullish ones now. And of course, I'm just going to avoid stocks between now and expiration. That's not a lot of criteria, is it? Not at all. But let's look at one of these trades off the bat. You got Costco here trading at 158.69. We're looking at about, this is actually a 3.5 point spread because it's just greater than 2. So I tell you what, Ron, let's take Wynn Resorts. I'm looking at Wynn, 134.38. September 1st, we could sell the 129 put for 83, buy the 127 for 56, a 2-point spread. It's a 15.6% return, 27-cent net credit, probability above 80.9%. No earnings between now and expiration. Another thing I highlighted over here, and the range, I'm sorry, the range out of the money is 4%. So I've got that good 4% cushion for a 9-day trade. Probability based on past performance of the stock, double-digit return, 27-cent net credit on a 2-point spread. Notice that in this, even what I mentioned earlier about the idea of looking for that average stock, and I put in a historical volatility, I have nothing in my filters for historical volatility or implied volatility of the options. Why? Because I'm already screening by that, based simply on the other criteria that are being used. Notice that the implied volatilities of the short option are between 0.18 and 0.35. I've already restricted it based on the probability and looking for stocks in an uptrend and above their MACD line, even with recent hiccups in the market. In addition to that, without screening by delta, I'm already in the 0.13 to 0.22 range. I bring that up again because I know there are other services out there that teach spreads, and there's nothing wrong with that. Competition is a healthy thing. But they teach spreads where you don't want to open a spread where your short option delta is greater than 0.2 or sometimes greater than 0.3, which would equate to a 69 or 70% probability. I use a 75% probability, so all of my deltas are below this as well. Okay, now let's go ahead and clear that out also. Let's take a look at just the profit and loss chart for a second. I'm going to give you an insight into one of the 7 things we're going to cover in tomorrow's presentation. Why was I always starting with this idea of a 2-point strike difference or higher when looking at spread positions? And one of the reasons is for an additional management technique on the spread. Now here I'm selling a 129 and I'm buying a 127. If the stock starts to fall against me and it hits my trigger points, whatever they might be, we'll cover that more in depth tomorrow. But if it starts to fall against me, one potential management technique, if I still have 5 days left or 4 days left to expiration, is to buy to close the 129 short put that's being threatened. And actually, instead of just buying to close, roll it down to the 128. If the premium is there, I might end up still with a profitable bull put at the 128, 127, but I only had to add in one other commission to still have a profitable trade with another $1 of cushion underneath of it. If I do a 50-cent spread, I don't have that option. If I do a $1 spread, I may be able to roll down to the next strike if that offers 50-cent premiums. But when I see dollar strike differences on a security that I'm interested in trading a spread on, I set it at a 2-point difference to have this extra little management technique available in my pocket. Okay? 5-point spreads, you could do that if it offers 250, or you could even roll down more. But that's one of the reasons I also focus on a 2-point spread. And I just wanted to show that with the profit and loss chart here. So this is a reasonable return with a reasonable probability. Now let me go back one just to discuss this further. Let's take a look at Wynn Resorts. I want to take a look at the stock chart. For some of you, let's see if I don't have it defaulted, my apologies. But let's go ahead, and usually what I look at on my charts is I'm going to go to maybe a 6 or 3 month chart. Ernie uses 3, I tend to use 6. But one of the filters I was using, of course, was the SMA 20er. So I want to put that in as well. Now I might use Bollinger Bands, but we didn't use that as a search filter because we found it didn't work out as consistently. But what we did find for the neutral to bullish positions, I'm just going to add RSI in too, and we can put in volume in any case. Everyone has their own way of reading charts, but I just wanted to show this for others. What am I looking at with the MACD? Even though this one's actually looking a little bit weak. But when we talk about a MACD crossover, we're looking for where the blue line, the MACD 9-day EMA, I'm sorry, the MACD 1226 crosses the signal line, the 9-day EMA. So we see a positive crossover here. And it's slightly lagging, but what happens? Well, neutral to bullish. Crosses over here might be an exit point. Crosses here a little bit. There's another cross. So what did we have? About 5 or 6 days ago, maybe almost 10, likely due to an earnings pop, but that's okay. We had that MACD crossover. Now, I'll be honest with you. Let's go to a 1 month chart. See it a little bit better. Although the stock matches my criteria for MACD that I put into the system and I tested, one thing I might be concerned about here is it's slowing down, isn't it? The MACD went above the signal line. They both are moving above the divergence line, but it's starting to show a little bit of weakness today. But that's also a market correction. The market as a whole is slightly down today, August 23rd. Okay? But the stock was showing a lot of strength before the market pulled down. So is this recent hiccup, one-day hiccup, okay, going on a 9-day out trade, but is one-day hiccup a result of the weakness in the stock, or just the lowering tide pulling down all boats? Okay, that's the question that I'd have to further research and analyze as well. All right, but that's what I'm going to look for in my bullish positions. Now, how would it translate to the debit spread side? It's very simple. If you're doing bull call debits rather than bull put credits, well, I'm going to use that same stock criteria, aren't I? It's the same kind of approach. I'm going to look for stocks above the SMA 20. MACD crossover of greater than 3. No earnings. And the spread structure is also going to be the same if I'm considering it as a parity trade to my bull put. I'm going to look for that 75% probability above. I'm going to look for a strike difference of greater than or equal to 2. And I am going to look for a range out of the money of greater than 3%. But now instead of a net credit of greater than 20, I'm probably going to use a percent return of greater than, let's say, 5 or 6%. So let's go ahead and do that. Let's go to bull call debit. We'll put in our criteria, same as we saw. First steps first, I'm going to clear the filters. Okay. Let's put in our expiration time frame of 8 to 17 days out in time. Now the net credit, this is a negative net debit. I'm just going to focus on the return of greater than 5%. My strike difference, again, greater than equal to 2, with a probability of greater than 75% on the position. Okay? Okay? Andrew, I'll get to that in just one moment. I'll do it with this one as well. So what else did I need? Well, my technicals, need the stock to be above the SMA 20. And I want that MACD crossover greater than 3 days. Remember, this is for the bullish. And for the fundamentals, let's avoid earnings between now and expiration. And of course, as we did, just to be fair, I am going to remove the indexes and ETFs from this position as well. Why? Because we wanted a little bit more volatility. All right, so let me go ahead and submit that. I think I got everything in there that I wanted to. No earnings, MACD over 3, stock above the SMA 20. Did I put the MACD in correctly? I don't think I did. Yep, no, over 3. I can put positive as well. There we go. I'm going to change the MACD to being positive also. Now, sorry about that. Let me run it again. There we go. So interestingly enough, we see Wynn, but we have some different combinations. We see the 3-point spreads still offering that high return. What was our combination? It was the Wynn 129, 127. There it is. Oh, I just had it, sorry. Yep, 129, 127. Here the bull call debit only offers an 8.1% return, where we saw the higher return, 20 cents on a 2-point spread. Here our debit's 185, so we'd make 15 cents on a 185 risk. So it's a lower return. But we're seeing the exact same similar stocks, Costco, BABA, and Wynn. Why? Because of the same stock criteria. Now, Andrew asked a question. He says, what about bid-ask spread? Now, honestly, I don't pay that much attention to it. When I do the testing, it is based on midpoint, and a lot of times on these larger stocks we're looking at, Wynn, Costco, BABA, I'm going to be able to get the midpoint prices for selling and for buying. But one of the other features that is on power options, of course, if you wanted to limit the short option bid-ask spread or the long option bid-ask spread, you could plug that in. Andrew, I don't have any comments about how that results with testing, because most of our testing is solely based on using midpoint, where with the larger stocks you're able to get that. And, ooh, no, that's still good. Okay, let's see. Let me see if there's anything else that came in here. My apologies. Okay, Don said that no audio was coming through, but I'm showing full audio and no one else commented. So Don, if the audio dropped out, I'll send him a quick message personally. If anyone else is having audio problems, let me know. Okay. But this is the same kind of thing I'd expect, testing-wise, with this criteria. Okay, David said it's okay there. Good. Okay, so it sounds still good. Now, with all of the things that are available to screen by, all of the things that we could look for, earnings per share growth, which I usually put in for more bullish positions, long calls, married puts, maybe even standard callers. I might even use it for some of my covered calls, but Ernie did all that testing for me, essentially. But price to earnings, price to book, market cap, other technicals, RSI, and so forth, why are we not plugging in more? And the reason why is because with this simple structure for bull put credit spreads and bull call debit spreads, we found results that are maximized, okay? Okay, let's see here. Aman says, simple question here, I'll send it to the chat and everyone. Aman says, how can I obtain the Power Option platform and screening tools that you were using? Okay, at any time, just go to poweropt.com. Okay, poweropt.com is the website. When you go to the website, you'll see just a simple form on the right-hand side for name and email address. That's all you have to put in and click Start My Trial. You'll have access to a 14-day free trial to the Power Options tools. Of course, we're focusing just on the credit spread structure right now in the search tool and the criteria. But we do support over 23 of the most commonly used option strategies. Okay? All right, so I go back one, and this might get a little confusing. I'm going to do my best to show it effectively. It was the fault of technology this morning, not that I wasn't prepared for you, okay? So let me do something real quick here. Let us go back once more. Now, I apologize. Let me stay here for a second, okay? And let me go back to the bull put credit search that we were just viewing, the search criteria. Here we go. Okay. Sorry, folks, it's coming up. 1 second. There we go. So the criteria, again, shown here on the right-hand side, bull put credit spreads. Expiration dates between 8 and 17 days. Minimum 20 cents of net credit. 3% out of the money. Strike difference greater than 2. Probability greater than 75. Above. Stock price above the SMA 20, MACD, cross signal at least 3 days, no earnings between now and expiration. Okay? Now, this is simple criteria, okay? Yes, it's Power Optimum, poweropt.com. You should have received that in the chat window. I'm sorry, okay? And I'm getting to the bear creds, Ron, and essentially, believe it or not, it's simply just reversing what we're talking about. Okay, that's why I usually save the bears to last. The other reason I save bears to last is as of yesterday's poll, 72% of the audience were focusing on bull call debits and bull put credits, if I remember correctly. I have it written down here somewhere, but the majority was looking at bull spreads. I feel the same way as you. I feel the market's going to change, and we're going to take a look at that in just a moment also in regards to what I would use for the bear spreads. But again, kind of what's good for the goose is good for the gander, isn't it? Simply reversing some of the bullish stock criteria, but the structure of the trade. Remember what I talked about in the beginning. Even though I showed the put chain for AMAT and I was showing the bull puts and the bear calls, the numbers for the structure and the expectation were about the same. If I'm in a bear call spread, I'm still going to look 8 to 17 days out in time. I'm still going to want a net credit of greater than 20 cents, still being 3% out of the money with a probability. The structure part of that changed. The system knows it's probability below instead of probability above, which would translate, as we saw, to short option deltas in a bear call spread of less than 0.25 or maybe less than 0.23. Okay? But the other numbers would still be the same. And then I'd reverse it. I'd look for stocks that are below their 20-day moving average that had a negative MACD crossover as well. I might even look for weak RSI. But in general, I'd reverse them. It's as simple as that. But the structure of the credit spread is the same. The criteria is the same because the system knows you're looking for a net credit. You want to be a certain range out of the money for your short call, which means above the stock price. You want a certain probability. For whatever reason, the testing has shown that $2 strikes or greater perform better long term than 50-cent spreads and 1-point spreads as well. We'll show that in just a moment. But first, I wanted to do this again. So let me go ahead back and let me talk about something that I did that Ernie showed me I was wrong but was still right, and then go from there. All right. So what I just showed you with bull put credit spreads over a 24-month time period, Ernie originally tested the monthly and weekly naked put screens from 6/20/2015 to about 6/20/2016. Okay, so for a 1-year time period for the weekly covered calls and weekly naked puts. In June, I had a customer during one of our Friday open discussion sessions ask me about, well, what about 2 years? Okay, so I tested the covered calls for 2 years and the naked puts as well. But that bull put screen I just showed you, what I did is I tested it from that time period of 6/20 to 6/29/2017, 2-year period. Now, I took an allocation of $10,000 to spread positions. And using that search criteria and taking the top 3 sorted by return. Yeah, top 3 sorted by return. The ending cash on hand after 24 months was $56,021, so a return of 460.2%. Don't get excited. Let me explain something that I did wrong here in just a moment. Now, over that time, there were 140 total trades. Okay, so taking 3 trades, starting out, looking 8 to 17 days out in time, every 2 weeks. But when the capital started to accrue, it actually went to weekly positions. It started trading every week once enough capital was available, but it was still looking for 8 to 17 days out in time. So it was an 84% win percentage. Remember, I was looking at a 75% probability, and over the last 2 years, it ended up with an 84% probability. And the average return on wins was that double digit we were hoping for, that 20.2%, close to what we saw with Wynn, which was only 15.2%. And the 22 losses averaged 63.8%. Okay? Now, this is a good leverage return. Running other tests using Bollinger Bands, using RSI instead of MACD, and other criteria, I was never able to get as high as this. But Ernie pointed out something very important, which also relates to our discussion today as well. We've talked about expectation. We've talked about structure. I've talked about the criteria for the bullish positions. But now, we talk about allocation. What is wrong with this picture? The main thing that's wrong with this picture is that if you told me you had a $10,000 account and wanted to trade spreads, I would move you away from this as fast as possible. In my mind, it made sense. Ernie's comparisons, doing the back testing for covered calls for the weekly and monthly picks of the day on power options and for naked puts, he was using a $100,000 account. Okay, and in the first year, he saw about a 42% return with the weekly covered call positions, applying some stops and other structures to the trades, and weekly naked puts was about the same. So I figured I'd beat him I more than 100 times, because I was saying, well, I'm going to allocate only $10,000 of a $100,000 account. But this was incorrect. What I did later on, where Ernie's showing me, is that you can't take the full amount of your portfolio and allocate it to spread trades. Even whether you're doing bullish or bearish, if you only have $10,000 to trade total, you do not want to do this, because there's a problem here. What do we know about spread trades that don't really happen with covered calls and naked puts? We know we can suffer large losses on both, but the debit spreads and the credit spreads all have one significant issue, that you can lose 100% of what you invested in the trade. So if I only had a $10,000 account and I put it into credit spread starting on June 20th, 2015 and allocated 33% of that into 3 trades, so $3,300 into each trade, if I was in bull puts and the market went south, I could have lost 100% on all 3 trades and been out of the market. What I'm saying is this is not a realistic number. What I was trying to show is that if I had a $100,000 account, I would only allocate 10% of my $100,000 account to spread tradings because of the risk inherent. And I don't, Ralph says margin. I don't trade leverage spread trades on margin, personally. All right, if it's, I don't know a lot of brokers that allow that, but if I have a $2 strike difference and I trade 10 contracts, they require me to put up the $2,000 to cover the spread. I'm putting up the $2,000. I don't want to put up 1,000, be 50% margin on a leverage spread personally. Okay? So what this means is that I would have taken 10,000 of the $100,000 and allocated here. So if in the first series I did lose on all trades, I would only be down 10% on my total portfolio, and I could still continue to trade. So in reality, yes, $10,000 allocated over a 2-year period with that criteria I showed you would have been a return of $56,021. Now sometimes 5 spreads appear or 6 spreads appear in the results. We saw 4 when we ran the search for bull put credits, okay? But I was only taking the top 3 sorted by return. Okay, so this wasn't a 460% return. It was taking a $100,000 account and ending at $156,000, so it was a 56% return over a 2-year period. That's the expectation that we saw with our criteria. Now, I'm going to open another window. I'm going to try to open another window, and I want to show you something because we want to know the other comparisons of the same nature. Okay, so this is where allocation comes in. Big part I don't have a slide for. You'd never allocate 100% of your portfolio to spread trading. Even if you were going to do 10 spreads and only allocate 10% per each for diversification. Because if you're doing bull put spreads and there's an unexpected event, you could wipe that out entirely. Okay, that's not, $1,000 into 10 spreads if you started only with $10,000. You really only want to be doing this with 10 to 20% of your trading account, of your available capital. Because bear or bull, debit or credit, because of the lie of leverage, one bad week, one bad month, one bad cycle could take out all of your trades. And although this is a good win percentage and what we need to be successful in spread trading, can we enhance it? Well, for our testing, that is what we did. Okay, now this is where it's going to get confusing, and I apologize, but just give me 1 second. Okay, and let me open this up here full screen. All right, let me find out where I am. There we go. Okay, so keep in mind these values up to 56. The ending cash amount is 56,021. Okay, something that was interesting. I want to keep your mind on your losses. 22 losses, 84% wins, 63.8%. All right, now I'm going to highlight something for you here, and I apologize for this. Here's the results of a second test. Same allocation. Same starting cash on hand, of course, but ignore this. This is 55.7% return, okay, on that range. Okay. Oh yeah, I was setting it up, David. That's why it wasn't showing. All right, so let me do it this way instead. This is actually a write-up I did. So same 2-month period. Highlighter does not show up well. Same 2-year period. My apologies. 24 months. I was able to use that same stock criteria and the same option criteria for bull puts, 8 to 17 days out and more. And the cash on hand, instead of being ending amount of 56,000, was 65,570 with a 94% win ratio. Same 140 trades were made, but this time we had only 9 losses over the course of a 2-month period, and the average loss was only 41.1%. But the average win was only 8.9%. What changed? Well, remember, I know it's hard to see, but I'm going to try to write this out. Ending amount of 65,570. So on a $100,000 account, but a 165,570 instead of 56,021. That was what I showed you originally. Okay, lower this by a factor of 10. Okay, so it'd be 55.7% gain. 9 losses instead of 22, and an average loss of only 41% on the losers, but an average win of only 8.9% instead of 20% average winners. What did I change? This track record, this test that I prefer myself, did one simple change to that criteria in the bull puts and the bull calls. What was the one simple change? I sorted by highest probability. So looking for the ones with the higher probability, which we saw would give us the lower return, instead of highest percentage return. My average percent on the wins was lower, my average losses was lower, and I only had 9 losses over the course of a 2-year period. Now, it was a bullish year. There were some hiccups there, but again, this just illustrates again how it's not necessarily a bad idea to consider looking at higher probability trades with still a reasonable return. What do I mean by that? Well, we saw earlier, if you go to that 95 or 99% probability, we're looking at credits which wouldn't have matched anyway. I wouldn't have seen the 20-cent net credits. They would have been filtered out. But maybe taking an 85% return on the position, okay, versus a 70%, I'm sorry, an 85% probability with a 9% return as opposed to a 70% probability with a 15% return, it actually had a better track record. This was still with 2-point spreads. This was still going 14 days out in time. Okay? Now, let me scroll down a little bit and show you something else here very quickly. Oh yeah, David says there's 2 questions here. The first question, I'm sorry, was for Ron. He says, is this ending cumulative return after commissions? No, but think about it this way. Notice one thing I'm not mentioning here. No stops. I tested this without any stops first to see how it would perform. Okay? So I opened 140 trades over a 2-year period. Well, you multiply 140 by essentially $8.95 for each spread to enter. No exit positions, and that would give you the subtraction from $65,570 over that time period. Okay? And I'll enhance that later too. Now, are the returns of this bull spreads over this 2-year period affected by the fact that there was a strong bull market? Yes, David, of course there was. And if I'm in a bearish market, but remember, let me pause you one more time and go back to one other screen. There we go. And let me show you something here. Nope. It's not going to change yet. Wait till I get there and I'll show you. All right, without all the fanfare and without all the other indicators and everything else along those lines, here is the SPX standard market over that 2-year period, close to the 2-year period. Okay, I'm going now more from September to now instead of June. Let me put in our time frame, okay? Sorry, folks. I gotta go to time frame, chart range, custom 6/20/2015 to 6/29/2017. All right. So was it helped by the large bull market? Absolutely. Okay. There was a good bull market from 2096 at the start. No, it didn't update. There we go. Okay. So we had a bull run, but significant downturns. Little hiccups. Here's a big hiccup here, little hiccup here, and a big one right off the bat as well. Okay. So we're just showing you long term what works. Okay. All right. And Sean, I'm going to get to your question in just a moment. Okay. But, you know, the bear call spreads didn't have as high as a return over this period because it was a bull market, but it still did well. because of the structure of the reasonable probability, not a lot of spikes up, gradual moves up, where the bear call still could have been successful, just not as successful because you mentioned it was right. You were in a bullish market. Okay? All right. Now, to Sean's question, which I was getting to, and I had mentioned this, I don't know if you were earlier in the presentation, I mentioned it, but I didn't exactly show it, and I've got to hunt for it for a second. But Sean's question is, have you done this backtesting using weekly when you talked about using 14 days producing better results? Yes, I did. Okay? And we talked about that as well. Okay, and I'm sorry, Mark, maybe I didn't explain this well. Let me go back to where we were, okay? I'll take Mark's question first, and then we'll go back. And I apologize if these aren't on slides, but we had some technical issues at the beginning. I'm sorry, technical issues here with the slides at the beginning where it didn't get to show. Okay, so Mark says, does your test accommodate when the drawdown occurs? For example, what if the drawdown happens right off the bat? Your first 3 trades would have gone to 0. Yeah. So if I had to run this test that I mentioned using the bull put spreads, and the first test I ran on 6/20 for the expiration date 14 days out in time, all 3 trades had gone to 0, the test would have stopped. There was a drawdown in that first cycle, believe it or not. 2 of the 3 trades went against me. So I started off lower, but it was still able to return positively. This is the fault that Ernie mentioned to me, where this number is vastly exaggerated and incorrect. This is really, I'm starting with a $100,000 account, but only allocating 10% to it. So even if I did lose on the first 3 trades right off the bat and lost 100% right off the bat, I still could have decided to continue it, investing another 10% of the $100,000 account, realizing I might take a 20% drawdown at that point if I lost again the 3rd time. And then we would have changed the testing criteria. Okay? So it would have taken into account. It just didn't happen. But again, that's what I was referring to earlier. Never take your full account and invest it into spread trades, because one bad cycle could wipe you out entirely. Allocation, only use 10 to 20%. Okay? Yeah, and that's exactly right. Now, Sean's comment is, okay, done this back testing. Now let me go back to where I was. Now this is the write-up I was looking at, and I'm sorry that it's not exactly the best view of it. But again, let's just get to it, okay? Let's go back to where we were, showing the testing results here. So this is my preference. Those bull put or bull call debit spread criteria I showed you, sorted by highest probability, less losers, less worry, lower percent return on the average on the winners, but higher overall return over time. Now, pause the screen and find it what I want, okay? Now, are you seeing this? Hopefully. 1 week out, bull put spreads after adjustments, no stops, same as before. So these are using the 2-point spreads only 1 week out in time. Ernie already found that the 2-week spreads 1 week out or 2 weeks out perform better than the 1 week out, because you do get a better net credit, which means you don't minimize the losses. Taking that same stock criteria, using 2-point spreads, and going every week, week by week, every 5 days, opening on a Monday for the 5-day trade, allocating $10,000 and 3% or 33% to each trade of a $100,000 account, the ending cash amount of the investment was a loss of 71.2%. There were 223 wins, but 25 losses. The win percentage was 90%, but the average return on the wins was only 8%, and the average return on losses was 71.2%, because the positions were getting cleaned out much faster. Still, with a 90% win rate, the average losers on the 1-point spread, you're losing more. See, if I sold a bull put spread, we're talking about AMAT. If I sold with the stock at 43, if I did a bull put with a 42-41 combination and a 42 and a 41 combination, but if I did the 1 week out, 42-40, and the stock fell, remember, I only took in 8 or 10 cents as opposed to maybe 17 or 18 cents for the 2-week out. Maybe not double. I just can tell you these were the results. It shocked me. Same criteria, 2-point spreads, looking for every 5 days, opening a trade every Monday, double the trades, 248 almost, double the trades. Losing cash value, 71.2% drawdown. I know that sounds strange and it's not possible, but I tested it 3 or 4 times. It did not do well at all. Okay, that's why we focus. Ernie saw this in other tests he did too before we started doing this intensive testing with the bull puts now. And that's what he found, is that the 2-week out is the sweet spot. 8 to 17 days out. Looking at the 10-day out instead of the 9-day out instead of the 2-day out positions, they perform better. Okay. Yes, the in-the-money debit spreads do have a similar result, Ellis. When I showed the search, when I did the bull called debit spread search using the same criteria with the same probability, 17 days out in time, we saw the exact same stocks with some subtly different combinations, but the same combinations were there with the bull put. The returns taking the top 3 sorted by probability were similar. That's what we found with this particular criteria. And why did I stop with this criteria that I had mentioned? Because I tried other criteria just as Ernie did, and I wasn't able to beat that 56% gain that I saw with only 9 losers and a 94%. Andrew asked, did the 2-week beat the monthly? They were about even, honestly. They were about even. So you could save some commissions by going out to the monthly. And what was interesting, Andrew, is a very good point. What was interesting is that some of those more gradual run cycles we saw in SPX before the hiccups, the monthlies were looking like they were really outperforming the weeklies when you had a nice slow growth run up. But then when you had a hiccup, they sort of caught up to each other. It was kind of interesting in that scenario. Now, one other thing I just needed to show, and I'm sorry I'm taking so long here, but it was important. Okay. All right, let's see here. All right. One last strange thing. Same results. Okay, here's the bull puts sorted by probability, 2-week out in time, 8 to 17 days out in time, 1 strike or less, allowing for 50-cent strikes or 1 strikes. Same time frame, same starting basis, almost the same loss. 82% win rate, but the average losers because the spread was shorter. So in a 1-point spread or a 50-point spread, if the stock pulled back 4%, you were at 100% loss of what you invested. Whereas with a 2-point spread, you would have only been 30. Okay, and the average wins were still about 20%, but this one ended up with a 72% loss. Same stock criteria, same essential spread criteria, sorted by highest probability of success, ended losing amount when using 1 strike or less compared to 2 strikes as well. Okay. Sean, okay, one last review. This losing track record is using 2-week out spreads that are 1 strike or less. Same stock criteria, 72% loss. Okay, this other one that had a losing track record was trying to go 1 week out in time instead of the 2 weeks out in time. 71.2% losses, same stock criteria. The one where it went up to 65,570 was the one that was 2 weeks out in time. Okay, now that's the changes that were made. That's why that's what's available as well. And Ron, I'm just going to add this one more time. Believe it or not, this one here with only the 9% losses, Ron asked the question we're going to address tomorrow. With your losses, did you wait until expiration or cut your losses earlier? Waited to expiration. Why? Because when I did put in a stop order on this particular screen, sorting by probability, to put in a stop if the stock hit the short put strike price and close out the position, or to put in a stop if the stock dropped 5%. The number of losses more than quadrupled. It was better to leave them alone. When you're sorting by highest probability, it's better actually to allow some of them to take the full loss without putting a stop before it, because some of the eventual winners, the stock fell and then moved back up, and they ended up being winners. But tomorrow we're going to address that, and we're going to address it with the management techniques as well. Surprising also. Andrew said, did you test 5-point spreads? Well, we're going to have that. We're going to have the full write-up available for power options users, because where am I going with all this? Well, for bull puts and bear calls, similar results with the bear calls using the reverse that I mentioned, looking for stocks that were below their 20-day moving average, and of course stocks that had a recent MACD crossover to the downside, avoided earnings between now and expiration, but spread-wise, still the 75% probability and more. That's the same thing, and we saw similar results with the bear calls. Why is that important? Well, I had mentioned to you earlier, let me just add another strategy here to cover calls real quick. I mentioned after Ernie's extensive testing, that one of the features power options users have, and they can go directly to see the weekly picks of the day for covered calls, monthly picks of the day for covered calls, and more. In the next few days, power options customers are going to have that available in bull put credit and bear call credit as well, and probably bull call debit. But to start, bear call and bull put, we'll have monthly and weeklies, and the full results will be developed. Okay, but that is where I was going with the results. That's why I wanted to show you those results on the positions and what we talk about working for criteria. This is what we have found. And by the way, if you think your results are better, you think your trading criteria might perform better than what I showed, I'd love to see it. And I wouldn't share it with everyone, okay? But where I'm going with that is that we do offer a service. If you're a power options customer and you want to see how your search criteria and trading plan are performing, for $50, what you could, oh, sorry, let me go there. For $50, one-time cost, we have it in these available strategies. And of course, what you can do is send us your search criteria that you're using in power options, the time frame that you want. We'll run that test over 2-year, 3-year, 4-year time period, whatever you want, and see how your returns would have performed against what we're going to post up for the weekly bull puts and the weekly bear calls as well. And the full description will be there also. So you can check that out at powerop.com. In the store there, the strategy testing service, build your own search, put in your criteria, let us know what you want to test. For $50, we'll run that test as we ran ours and see how it stacks up against it. And again, as I mentioned, of course, you're going to see those weekly bull puts, credits, picks of the day. We're probably just going to stick with the weeklies since the monthlies didn't really outperform it, but we might show both. We'll show the weekly bull puts with the criteria and the weekly bear calls probably coming out on Friday for you power options subscribers and customers as well. But the criteria discussed today is what that's going to be based on. So you have a vantage point to go ahead and try to use that, see how it stacks up against your returns over the same time period. And just wanted everyone to remind everyone, of course, today's webinar is archived. It is recording right now. We are going to post it into the Options Strategies archives. There's yesterday's debit spreads versus credit spreads. And again, you can sign up for our other presentations coming forward there from the webinars page. It's powerup.com/webinars.asp. Tomorrow, management of the spread positions, ideas for management and adjusting. Talk about the track record in regards to what we did for stops there and how that affected it. And then the open discussion on Friday as well. Now, I don't have anything else. I know I extended the time there. I know it wasn't as easy to read because we couldn't get the slides completely performed for you, but we'll enhance that later on as well, okay? Sean, okay, you just said if we don't have strategy criteria, could you provide the optimum criteria for each strategy? Well, I just told you that's what we're going to do. For covered calls, if you ask me what is the optimum criteria, I'm going to tell you it's the weekly picks of the day or the monthly picks of the day. Weeks and hours of Ernie's testing, different strategy criteria, structures in the money, out of the money, 1 week out, 2 week out, and so forth. That was the optimized return. What we're going to post for bull put credits, what I just showed you today, and for the bear call credits, that is the optimized strategy criteria we have right now with hours of testing, standing on what Ernie had already done for bullish and bearish positions, seeing what we saw for 2 week out spreads versus 1 week out spreads, 2-point spreads versus 1-point spreads, and the combination between. That is our optimum criteria right now. If anyone thinks they can beat us, I'm more than happy to see it, and we'll be more than happy to test it for you. But the reason the search criteria are there, no, not, that's what I'm saying. I'm sorry. See, if you go to covered call weekly picks of the day, you see the results. But if you click on see how we develop these results, the criteria is shown for you. It's shown for you in the description. And if I go to the search, by the way, covered calls and power options, like you'll be able to do with bull puts and bear calls, I go right into the search. One moment. Are you guys seeing that yet? There it is, okay. I go to weekly picks of the day. This is the optimum criteria that Ernie found, shown right here on power options in the search for the weekly covered calls, weekly naked puts, and I'll be showing them you'll see them for the weekly bull puts and also the weekly bear calls. Okay, so that'll all be available for power options customers as well. Okay, so I'll let you know when today's webinar is posted. Remember, at any time, if you haven't done so already, you could just go to powerop.com. I'm sorry, folks. Let me go back to Power Options. And right there, you can just put in your first name, last name, and email address, and you can start your free 14-day free trial. I will email everyone when this webinar has been archived and recorded and posted on YouTube and on our free webinars page. We'll, of course, include an invitation to tomorrow's presentation on the management techniques as well. Well, ladies and gentlemen, I want to thank you for joining me today. I do hope to see you later on this week. I hope you got some useful information out of today's presentation. Take care, everyone. Happy trading. Good night.